What is the difference between a deferral of tax and a permanent tax savings? Well, most tax planning is deferral, which means you're just kicking the can to next year. So you might, the best example and easiest example of a deferral is you're coming up to December 31st and you write checks to a bunch of vendors for $10,000 and you get a $10,000 deduction before the end of the year. Well, all that's really doing is giving you a deduction this year that you're going to have to pay $10,000 more in tax next year. It's not a permanent savings, it's just kicking it to next year. It's still a good strategy because if you do it every year and year out throughout your career, 30 years of saving 10 grand a year is still pretty good. And if you can keep that $10,000 working capital to grow and invest your business, then it's worthwhile doing. Permanent savings is we did a strategy, it lowered our tax bill, and we never have to pay that again. An example of that is forming an S corporation. You can come by. What is he making goofy? An example of that is forming an S corporation because you lower your self-employment tax by up to $13,000 per year, and that is permanent savings. You never have to pay that back. So ideally, the best tax strategies are ones that are permanent, not deferrals. But if you have an opportunity for either one, it's good to do both. But ideally, a better strategy is the permanent savings.